Imagine studying for weeks, right? You walk into a massive midterm and you just absolutely crush it.
Oh, man. Best feeling in the world.
Right. So you score a 98, you bring that test home, you drop it on the kitchen table, fully expecting, a celebratory dinner.
Yeah, maybe go out for pizza or something.
Exactly. But instead, your family takes one look at the grade, they confiscate your car keys, and they ground you for the weekend.
Wait, what, over a 98?
Yeah, over 98, because you casually mentioned that you might only get an 85 on the next quiz.
Oh, wow. Okay, yeah, that is brutal.
Right. You did everything right in the moment, but you're being aggressively punished for a cautious prediction about the future.
Honestly, that is the perfect way to visualize the psychology of the stock market, especially, when you're dealing with high-growth companies.
Because they expect perfection.
Right. The market rarely rewards you for what you just did.
No.
It prices you based on what it demands you do next.
Which is terrifying.
It is. If you hint that the future might be even, slightly less spectacular than the present, the reaction is just swift and punitive.
And that jarring disconnect, that gap between a stellar present and a punished future is exactly what we are unpacking today.
Yes.
So welcome everyone to this custom time and market deep dive. We're super thrilled to have you with us as we tear into the numbers.
I've got a lot to cover today.
We do. Just a quick note as we get started, though. We are looking at real data, trends, and market sentiment, but this discussion is purely for entertainment purposes.
Definitely.
Yeah.
Always, always seek out professional financial advice before making any actual trades based on what you hear today.
For sure. Also, if there are other companies, trends or market anomalies you want us to explore, drop us a comment. We build these deep dives around the topics you want to figure out.
Because the current market environment is, it's highly reactive right now.
Very reactive.
So having a clear understanding of the underlying mechanics of these companies is really the only way to cut through the noise.
And the company generating all of the noise today is Netflix, ticker symbol NFLX.
Yeah, they've had quite a week.
We're taking a snapshot of their landscape as of mid-April 2026. Taking a step back, the stock is actually up roughly 18% since the start of the year.
Which is a really solid run, honestly.
A great run. However, the stock just cratered, dropping about 9% in after-hours trading.
Ouch.
Yeah. So our objective today is to figure out the why behind that sudden crash.
Right. We need to dig into the details.
We will comb through their Q1 earnings, evaluate their key valuation multiples, contrast their position against Disney, and weigh the current analyst sentiment to deliver a final buy, hold, or sell verdict, all based entirely on the source data provided.
The fundamental question here is whether that 9% after-hours drop is a massive overreaction by a skittish market, or, if it's the first real crack in the foundation of the dominant streaming narrative.
Let's start with the actual report that triggered the drop. We can call this the earnings paradox.
It's earnings paradox. I like that.
Because looking at the Q1 2026 numbers, Netflix printed a phenomenal quarter. Revenue came in at $12.25 billion.
Which is huge.
It's a 16.2% year-over-year increase, comfortably beating Wall Street estimates.
Right. And their operating income hit $4.10 billion.
And their profit margin actually expanded to 32.3%.
Yeah, from a pure operational standpoint, those are just incredibly robust figures for a company of this maturity. Generating over $12 billion in a single quarter with expanding profit margins, it proves they still have tremendous pricing power.
They're making more money on the same stuff.
Exactly. They are squeezing more profitability out of their existing revenue streams.
But then the closing bell rings, the report drops, and the stock immediately plummets down to around $97.86.
It just falls off a cliff.
Right. Looking through the details, the culprit isn't the quarter they just finished. It's the quarter they are about to enter.
Yeah, the Q2 guidance.
Netflix forecasted their Q2 revenue at $12.57 billion and earnings per share at 78 cents. Both of those forward-looking metrics missed the consensus estimates from Wall Street.
And on top of that, Netflix warned that their operating margins are expected to compress. They're dropping down to 32.6%.
Which brings us to the jargon. The reason they gave for this margin squeeze is something called front-half-weighted content amortization.
Ah, yes. Classic corporate speak.
Help us translate that phrasing. Why is their profit margin temporarily shrinking?
So we have to look at how the accounting actually works for producing television and film. When Netflix spends, hundreds of millions of dollars to produce a massive new series, They don't expense all that money on the income statement on the day the show premieres.
That makes sense.
Right. They spread those costs out or amortize them over the expected lifespan of the content.
Okay.
So front-half weighted content amortization simply means they are launching a really heavy slate of highly expensive shows early in the year.
Oh, I see.
The accounting rules literally force them to recognize a large portion of those production costs on their Q2 income statement.
So their revenue might still be strong, but the heavy upfront costs of that new programming are temporarily eating into their profit margins.
Exactly.
They are basically footing the bill right now for the big summer blockbusters we are going to binge later.
Yep. The cash might have been spent months ago during production, but the accounting hit lands in Q2.
Still, a 9% drop feels, I don't know, violent for what is essentially a timing issue with their accounting.
It does. But the drop isn't just about the accounting mechanics. It's about the expectation game.
Back to the 98 on the test.
Exactly.
Yeah.
Wall Street looked at how much Netflix beat expectations in Q1 and just assumed the company would aggressively raise its financial targets for the entire rest of the year.
But they didn't.
No. Netflix management chose to be conservative. They simply reiterated their previous full-year target of $50.7 billion to $51.7 billion. They didn't lower it, but they didn't raise it either.
And for a growth stock, simply maintaining the status quo is treated like a failure.
Totally. When a company trades at a premium valuation, investors demand constant escalating upside. If the company signals a period of even slight moderation, the momentum traders immediately head for the exits.
That makes the market psychology clear. But if we dig a little deeper into those incredibly strong Q1 numbers we just discussed, there's a fascinating anomaly.
Yeah, the balance sheet hides a secret.
Right. The profitability looks fantastic on paper, but a massive chunk of that success actually stems from a failed mega merger.
This is wild.
We need to talk about the $82 billion elephant in the room regarding Warner Bros. Discovery.
This is perhaps the most critical piece of context for the entire quarter. The Q1 earnings are heavily distorted by a massive one-time influx of capital.
According to the timeline, Netflix recently made a very aggressive $82 billion play to acquire Warner Bros. Discovery, but they lost.
Right. Paramount came over the top with a superior bid, and Netflix walked away. Now, usually, losing out on a major acquisition is viewed as a strategic defeat. But Netflix somehow walked away from this failed deal with a $2.8 billion termination fee paid directly to them.
It's incredible.
How does a company fail to buy someone and still walk away almost $3 billion richer? What is the actual mechanism there?
Well, it comes down to the mechanics of corporate bidding wars. When Netflix initiated the process to buy Warner Bros. Discovery, they likely signed an agreement that included a breakup fee.
Okay.
This is pretty standard in major M&A mergers and acquisitions. It protects the initial bidder because Warner Bros. Ultimately accepted a higher competing bid from Paramount. Warner Bros. Was contractually obligated to pay a massive penalty fee to Netflix for breaking their initial arrangement.
Oh, wow.
Yeah, Paramount essentially had to fund that $2.8 billion penalty as part of the cost of winning the deal.
So Netflix was essentially acting as a stalking horse, and when Paramount wanted the prize badly enough, Netflix got a $2.8 billion consolation prize.
Not a bad day at the office. Seriously. That completely changes the context of their Q1 free cash flow, which they reported at a staggering $5.09 billion.
Right. Without that breakup fee, their actual operational cash flow is less than half of what the headline number suggests.
We need to define why that matters for you listening. Free cash flow is the actual cash a business generates after paying for all the necessary capital expenditures to keep the lights on things like servers, office space, and production equipment.
It's the money left over that a company can use to pay down debt, buy back stock, or save for emergencies.
And by injecting $2.8 billion of pure penalty money into that metric, their earnings per share and their overall cash position look artificially inflated for this specific quarter.
Exactly. It's a windfall, not a recurring revenue stream.
I see the logic there, but let's look at the bigger strategic picture. Missing out on the Warner Bros., intellectual property, DC Comics, HBO, all of that catalog, that is a massive arsenal to hand over to a rival like Paramount.
It's a huge catalog.
Was losing this bid a failure of execution, or was it actually a brilliant demonstration of financial discipline by Netflix's management?
From a capital allocation standpoint, you can make a very strong argument that walking away was the smartest move they could have made.
Really?
Oh, absolutely. Acquiring Warner Bros. would have meant taking on an astronomical amount of corporate debt. Furthermore, merging two colossal media entities with vastly different corporate cultures is historically a nightmare. It destroys shareholder value for years.
So instead of buying a decade of integration headaches and debt, they got paid to walk away.
Precisely. Look at their balance sheet now. Thanks to that termination fee, Netflix is sitting on $11.8 billion in total liquidity against minimal net debt.
Wow.
And the return on equity, which measures how efficiently a company generates profit from the money investors have put into it, is sitting at a very healthy 25.81%.
So they maintain complete financial agility while their rivals are bogged down in debt and messy mergers.
That's the real win here.
Speaking of avoiding messy situations, there is a significant leadership change happening simultaneously. Co-founder Reed Hastings is stepping down from the board to focus entirely on philanthropy.
Yeah, end of an era.
The source material highlights that Hastings has been a very vocal critic of the current administration and a known donor to Kamala Harris. We aren't here to debate the politics themselves, obviously, but how does the financial market interpret the exit of a highly political founder during a tense 2026 election cycle?
Well, the market evaluates leadership changes primarily through the lens of risk reduction.
Okay, how so?
When a consumer brand like Netflix operates in a highly polarized environment, having a board member who is a vocal political lightning rod introduces unpredictability.
Right, you don't want to alienate half your audience.
Exactly. It risks boycotts, regulatory scrutiny, or simply distracting from the core business. By Hastings stepping down, institutional investors view it as neutralizing a potential political target risk.
So it's just about stability.
Yeah, it allows the company to remain purely focused on entertainment, minimizing the chance of alienating any segment of its 325 million global subscribers.
It's about keeping the product universally accessible and avoiding collateral damage. And they really need to keep those 325 million subscribers happy because without the Warner Bros. Catalog, Netflix still has to justify spending an estimated $20 billion a year producing their own original content.
Which is a staggering number.
If they aren't buying growth through acquisitions, where is the organic growth coming from?
The organic growth is coming from fundamentally rewiring how they monetize the audience they already have.
Okay, talk me through that.
For years, the skeptical argument was that once Netflix hit over 300 million users, they would hit a natural ceiling. There are only so many households in the world with broadband internet willing to pay a premium subscription fee.
The assumption was that the market was fully saturated.
Right. But Netflix pivoted away from relying solely on premium subscriptions.
Yeah.
The true growth engine, right now, is their ad-supported tier.
Ah, the ad tier.
In the global markets where this ad tier has been rolled out, it currently accounts for over 60% of all new subscriber signups.
60%. That's massive.
Because of that volume, their advertising revenue alone is projected to double, reaching $3 billion in 2026.
Wait, I want to push back on that slightly. If 60% of new users are choosing the cheaper ad tier, doesn't that mean Netflix is cannibalizing its own revenue?
How do you mean?
Well, they are trading a customer who might have paid $15 a month for one who is only paying $6 or $7.
That is the common misconception, but the unit economics actually work heavily in their favor. Let's look at the ARPU, or average revenue per user.
Okay.
In the US and Canada, their ARPU has actually climbed to $17.26. Globally, it sits at $11.70.
So going up.
Yes. When a user chooses the cheaper ad tier, Netflix collects that smaller subscription fee, but they also collect the advertising revenue generated by that user watching commercials.
Oh, I see.
In many cases, the combination of the ad tier subscription fee plus the advertising revenue exceeds what they would have made from a standard ad-free subscription.
So they are essentially double dipping, and the total revenue per user actually goes up. That is fascinating. It also solves the biggest problem in the streaming industry, which is churn.
Exactly. Churn is the rate at which customers cancel their service. Historically, whenever Netflix raised prices to fund that $20 billion content budget, a predictable percentage of users would get frustrated and just cancel.
Right. I'm not paying $20 a month for this.
But the ad tier fundamentally alters the life cycle of a subscriber. It creates what we call a soft floor.
Meaning that when the premium price goes up, instead of canceling outright, the frustrated user just downgrades to the cheaper tier with ads. They stay inside the Netflix ecosystem.
Exactly. The retention strategy goes from trying to stop them from leaving entirely to simply offering them a different door within the same house.
That's brilliant.
Furthermore, they are still finding pockets of massive geographic expansion. Look at the Asia-Pacific region.
Oh, yeah, the source mentioned Japan.
Right, Netflix streamed the World Baseball Classic in Japan and pulled in 31.4 million viewers.
Mm.
Live sports are crucial because they are unbingeable.
Mm.
You have to be subscribed right now to watch it, which further reduces churn.
Okay, so we've established that they have a war chest of liquidity from the failed merger. They are successfully migrating users to a highly profitable ad tier, and they have an expanding global footprint.
It's a strong position.
Let's translate all of this business strategy into the actual valuation of the stock. At a price hovering in the mid-90s to $108 range, depending on how the after-hours volatility settles, is this stock actually priced fairly?
We evaluate that by looking at the key valuation multiples. Currently, Netflix's forward PE ratio, which compares their stock price to their expected future earnings, is sitting below 30x.
Okay.
To put that in context, we have to look at their historical baseline. Over the past 5 years, Netflix's average forward multiple has been around 38x.
So if it's trading below 30 now, against a historical average of 38, the market is currently pricing Netflix at a 21% discount compared to its own historical norm.
It is a significant discount. But another metric provides even more context: the PEG ratio, or price earnings to growth ratio.
Right.
This metric divides the PE ratio by the company's expected earnings growth rate. Currently, Netflix's PEG ratio is sitting at roughly 1.3x.
Let's decode that for the listener. A 1.3 PEG ratio on a massive tech company, what does that actually signal?
For a dominant technology or media company that boasts a 20% or higher earnings per share growth trajectory, a PEG ratio is typically well above 2.0.
Okay, so they usually trade at a much higher premium.
Right. Investors are usually willing to pay a high premium for reliable, compounding growth. When you see a company like Netflix sitting at a 1.3 PEG, it signals a deep tension in the market.
What kind of tension?
It means one of two things must be true. Either the stock is currently a massive, undeniable bargain, or the broader market is fundamentally doubting Netflix's ability to maintain that 20% growth rate going forward.
So the math indicates it's cheap, but market sentiment might be saying, we think your best growth days are behind you.
Exactly. The market is questioning if the ad tier growth is sustainable or if streaming fatigue is finally setting in.
Which brings us to the broader industry context. Netflix doesn't operate in a vacuum. They are fighting a daily war for attention. How do these financial metrics and growth strategies hold up when you compare them directly against a legacy titan like Disney?
Disney is a beast.
I mean, Disney owns Marvel, Star Wars, Pixar. That is the most formidable intellectual property catalog in the history of entertainment.
Disney's catalog is legendary, without a doubt. But corporate structure dictates financial agility. According to the AI analysis models from Tickeron, Netflix is actually strongly favored over Disney as an investment heading through 2026.
Really? Why is that?
The rationale comes down to pure play focus versus conglomerate complexity.
Because Netflix only does one thing. They deliver software and video over the internet.
And they do it with incredibly high margins. Disney, on the other hand, is a massive, sprawling empire.
Right.
They have the streaming service, yes, but they're also managing physical theme parks, cruise lines, and a rapidly declining legacy cable television network.
Steering Disney is like trying to turn a battleship.
Exactly. It takes immense time and capital. Netflix operates like a speedboat. They can pivot their entire pricing model or content strategy in a matter of months without having to worry about how it impacts foot traffic at a theme park in Florida.
The agility of software versus the anchor of physical infrastructure. That brings us to the final verdict. Taking into account the earnings, the valuation multiples, and the competitor landscape, what is Wall Street's final consensus on Netflix?
The sentiment is mixed, depending on the methodology you trust. The Seeking Alpha consensus, which aggregates various human analysts, rates Netflix a buy with a score of 3.60 out of 5.
Okay, pretty solid.
However, their quantitative models, which are strictly driven by algorithms and moving averages, rated a hold at 3.19.
So the human analysts see a buying opportunity, but the cold math suggests waiting it out. What about actual price targets?
This is where the divergence becomes extreme.
Oh boy.
Fundamental analysis, which looks at their $11.8 billion in liquidity, the 21% discount to historical multiples, and the ad tier growth runway, presents a clear buy verdict, with a traditional price target of $115 based on projected 2027 earnings.
That seems like a very rational, grounded progression from the current price.
It is. But if you look at aggressive AI momentum trackers, the algorithms that trade purely on volume, sentiment trends, and volatility, they predict astronomical upside.
Like what?
Some of these algorithmic models suggest the stock could average $850 by year-end.
Wait, an $850 price target?
Yeah.
If I'm a retail investor managing my own portfolio, that sounds like completely fabricated internet hype. How does any model justify a jump from the 90s to 850? How are you supposed to weigh a $115 rational target against an $850 AI target?
You have to understand that these two targets are measuring entirely different universes of physics. The $115 fundamental target is measuring the intrinsic value of the business.
Right.
It assumes the market will eventually behave rationally and price the stock based on its actual cash flow and profit margins.
It's investing in the company itself.
Correct. The $850 AI momentum target is not measuring the company at all. It is measuring the capacity for human and algorithmic frenzy.
Wow. Yeah.
Momentum trading algorithms look for patterns of volatility. They anticipate scenarios where a sudden rush of retail buying, combined with institutional algorithms piling on, detaches the stock price completely from reality.
A bubble, essentially.
Yes, the fundamental buy relies on the business executing its strategy. The AI buy relies on a speculative bubble forming. You just have to know which game you are actively playing.
That is a crucial distinction for anyone trying to navigate this landscape.
Oh.
Let's pull all these threads together to summarize what we've uncovered today. We started by examining the earnings paradox.
Right, the A+ test score.
Netflix put up massive Q1 revenue and expanded their margins, but the market violently punished the stock, dropping at 9% because of a cautious Q2 forecast caused by front-loaded content expenses and a refusal to raise full-year guidance.
The market demanded escalating promises, and Netflix offered grounded reality.
We also uncovered that those Q1 numbers were heavily subsidized by a $2.8 billion breakup fee from the failed Warner Bros. Discovery acquisition. But far from being a failure, avoiding that massive debt load allowed Netflix to maintain over $11 billion in liquidity, keeping their balance sheet incredibly agile compared to a bloated competitor like Disney.
They traded a messy acquisition for pure financial flexibility.
And they're using that flexibility to drive their new ad-supported tier, which is fundamentally changing their unit economics, creating a soft floor for churn, and increasing their overall revenue per user.
Strategies is working.
Ultimately, the fundamental model suggests the stock is trading at a 21% discount, leading to a rational $115 price target, while speculative momentum bots are screaming for $850. It's a company operating from a position of immense strength, but facing a market that demands absolute perfection.
It requires an investor to look past the immediate after-hours reaction and evaluate the structural integrity of the business model.
Absolutely. Before we wrap up today's deep dive, I want to leave you with one final provocative piece of the puzzle to mull over. Buried deep in the source material regarding their cash flow, there is a brief note that Netflix recently acquired an artificial intelligence company called Interpositive.
Oh, yeah, the Ben Affleck one.
Exactly, founded by Ben Affleck,
Yeah.
and acquired for $585 million. Right now, Netflix's biggest vulnerability is that they have to spend $20 billion a year producing content to keep their subscribers happy.
It's an astronomical overhead cost.
But what happens if generative AI drastically lowers that production budget in the near future? If a company like Interpositive allows Netflix to slash the costs of visual effects, background generation, scripting, or post-production by even 10 or 15%, that represents billions of dollars in savings dropping directly to the bottom line.
Which would be massive.
Right. Netflix could be on the verge of a huge margin expansion that traditional Wall Street analysts aren't even beginning to price into their targets yet. Something to think about as you evaluate how technology will continue to disrupt the future of streaming. Thanks for joining us on this deep dive.
See you next time.
Leave your thoughts in the comments. And until next time, keep digging past the headlines and questioning the numbers.